Falling for the age 62 trap could permanently cost you tens of thousands of dollars, especially with the recent Medicare premium hikes. Today, we're breaking down why claiming early is a massive mistake for most people, and more important, here is the brutal truth about what the Social Security Administration calls the earnings test. In 2026, if you claim benefits early and keep working before your full retirement age, you are legally restricted. The strict income limit is now capped at exactly $24,480. Go just $1 over this threshold, and the government immediately triggers a massive penalty. For every $2 you earn above that limit, they will claw back one full dollar of your benefits. The math is simple, and it destroys your monthly cash flow. Thousands of retired Americans get blindsided by this rule every single year. They try to boost their income, only to watch their hard-earned retirement checks completely vanish. But it gets even worse. But there is an even bigger danger that most people completely ignore: the survivor benefit. If you pass away, your spouse inherits your exact monthly benefit amount. By locking in a permanently reduced check at age 62, you are automatically leaving your husband or wife with significantly less money to survive on. It is a heartbreaking mistake that leaves thousands of widows struggling to pay their bills.
Uitwijving voor het maakt het suffer mee voor die dual situbert. In feite, billing more than jouw fee is simfording product.
Here's the brutal reality. If you claim your benefits before your full retirement age and keep working, the IRS sets a strict limit on your earnings. For 2026, that limit is $24,480. For every $2 you earn above that $24,480 threshold, the Social Security Administration clawbacks $1 of your benefits. Think about it. You are literally being penalized just for staying active and productive. You think you're getting ahead, but you're actually running in place. But that's only half the trap. It gets significantly worse when you factor in your combined income. The IRS doesn't just look at your salary. They track your wages, traditional retirement accounts, and half of your Social Security. If you are married and your combined income crosses just $32,000, up to 50% of your benefits become taxable. Cross $44,000, and a staggering 85% of your retirement check can be taxed by the government. To see how dangerous this trap really is, let's look at John. John gets $24,000 a year from Social Security and takes a fun part-time job paying $30,000. He thinks he's making $54,000 total. But because he is under full retirement age, the penalties and combined income tax hit him simultaneously. In a moment, I will show you the exact financial strategy to completely legally avoid this IRS trap. But first, look at what happened to John's paycheck. Because John was under his full retirement age, exceeding the earnings limit cost him $3,300 in deducted benefits. On top of that, his combined income triggered the highest tax bracket for his remaining checks. After paying federal taxes, state taxes, and the earnings penalty, John was effectively working for pennies on the dollar. So, how do you beat this system? Let's fix your roadmap. The first and most bulletproof strategy is understanding your full retirement age milestones. Once you hit your exact FRA, whether it's 66 or 67, the earnings limit completely vanishes. The IRS can no longer touch a single penny of your benefits, no matter how much you earn. But what if you want to work before your FRA? That is where strategic self-employment and retirement accounts come into play. If you push your business revenues into tax-advantaged accounts, like a solo 401k or a SEP IRA, you can drastically lower your net self-employment earnings on paper. By doing this, you keep your official income below the IRS threshold, stopping the government from clawing back your Social Security benefits. 6. Falling for the age 62 trap could permanently cost you tens of thousands of dollars, especially with the recent Medicare premium hikes. Today, we're breaking down why claiming early is a massive mistake for most people, and more important, here is exactly how it works. You split your business revenue into two distinct parts. First, you pay yourself a reasonable salary, which stays strictly below the annual IRS earnings limit. The rest of your profits are taken as business distributions. Because distributions are not classified as earned income by the Social Security Administration, they trigger zero penalties. But if your ultimate goal is to eliminate future taxes entirely, there is a third, even more powerful weapon. Let us look at exactly how strategic Roth IRA accounts can legally shield your growing retirement wealth from the federal government forever. Unlike traditional retirement accounts, a Roth IRA is funded with after-tax dollars. This means that once your money is inside the account, it grows entirely tax-free, and your future withdrawals are completely invisible to the IRS. Most importantly, the Social Security Administration does not count Roth distributions as earned income. By utilizing this strategy, you can pull large sums of money to live on, while keeping your official income profile completely clean and well below the penalty thresholds. But federal benefit clawbacks are not the only danger waiting for you. There is another hidden tax cliff that most business owners completely ignore until it is too late, and it involves your future healthcare costs under strict Medicare income thresholds. This trap is called IRMAA. If your business revenues push your total retirement income just $1 over the strict government brackets, your monthly Medicare premiums will instantly skyrocket. It is a massive surcharge that functions exactly like a hidden federal tax. However, because S-Corporation distributions and strategic Roth withdrawals are completely excluded from this calculation, keeping your income properly structured is the only way to safeguard your monthly healthcare budget. Now let's bring all of these powerful pieces together into your ultimate retirement roadmap. If you want to protect your hard-earned wealth and completely avoid the IRS benefit traps, here is the exact 3-step plan you need to execute right now. Step number 1 is to conduct a rigorous audit of your business structure. You must calculate your net profit and determine if transitioning to an S-Corporation will deliver the necessary tax shielding. Step number 2 is to formally set a reasonable salary that meets strict IRS compliance standards. This salary must be high enough to satisfy Uncle Sam, yet low enough to stay completely underneath the annual Social Security earnings limit. By balancing this numbers game perfectly, you effectively stop the government from clawing back your retirement benefits, while legally keeping the rest of your profits inside your own pocket. Finally, step number 3 is to build your ultimate tax-free fortress by aggressively funding your strategic Roth IRA accounts. If your current business revenues are too high to qualify for standard contributions, you must immediately implement the advanced backdoor Roth strategy. This sophisticated legal loophole allows high-earning entrepreneurs to completely bypass the standard government income limits. By shifting your wealth into this tax-exempt vehicle, you establish total immunity from future IRS rate hikes and completely eliminate the threat of the Medicare IRMAA cliff. Taking control of your retirement income is the smartest move you can make. Hit that like button, subscribe for more financial strategies, and drop your questions in the comments below. See you next time.